All right, here is 11-5. The Hartwell Corporation has been authorized to issue 25,000 shares, $100 par value, 8% non-cumulative preferred stock, and 1,000,000 shares of no par common stock. The corporation assigned a $4 stated value to the common stock. At December 31st, 2014, the ledger contained the following balances. You'll notice that it just shows them all on a list, but we would recognize that all of those, with the exception of treasury stock, would have credit balances, and the treasury stock would have a debit balance. Preferred stock was issued for $452,000 in cash. All common stock issued was for cash. In November, 40,000 shares of common stock were purchased for treasury at a per share cost of $17. No dividends were declared in 2014. Prepare the journal entries for the following: the issuance of the preferred stock for cash. So let's see. It doesn't give us a date, so we'll just go ahead and do the entry then. We'll say that was cash of $452,000. And then that'll be we'll list it as preferred stock. And the preferred stock had a $100 par value. So if they did, we see where their preferred stock had a balance of 400,000. And paid in capital in excess of par value on the preferred stock. Should be 52,000. And then the issuance of the common stock for cash. So again, the cash goes up. Tells us all common stock issued was for cash. So we know that if there was 2,400,000 in common stock plus 6,600,000 in additional paid in capital on the common stock, that's a total of 9 million. Common stock will be 2,400,000, and the in excess of stated value on the common stock be the 6,600,000. And the purchase of the common treasury stock for cash. So when we purchase treasury stock, we debit the treasury stock account. We do it at cost, $680,000. And we pay cash for it. Then it says, prepare the stockholders' equity section of the balance sheet at December 31st, 2014. All this information given to us is December 31st, 2014, so really all we have to do is enter it in to a format for the balance sheet. So that should be pretty doable. So let's say Hartwell. So we'll start with, this is the stockholders' equity section. So capital stock. We have the 8% preferred stock. Whoops. Again, we could put additional information, but I'll make that work. Common stock. This one's actually easier than 1 and 2, where we had to figure out all this stuff. Here it's just given to us and we just have to put it in the statement here. So we have the paid-in capital of in excess of par value on the preferred stock and in excess of stated value on the common stock. Again, the information is just given to us over here, 52,000 and 6,600,000. So our total and then we have our retained earnings. Which is given to us as 3,630,000. So we'll have our, whoops. Wait a minute, something's weird. Oh, I know what it is. I didn't do a total paid-in capital line. Which would equal the paid-in capital plus the additional paid-in capital. And then this line would be our total paid-in capital plus retained earnings. That smells better. All right. Less treasury stock. That should be 40,000 shares of treasury stock worth $680,000. Worth is a strong word. That's that we paid $680,000 for. So our total stockholders' equity will be the total paid-in capital plus retained earnings minus our treasury stock. And there it is. That's 12-5. Have a great week. Let me know again if I can help you in some other way.